Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, December 29th, 4:48 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the second to last of the year Revere Asset Management Daily Market Insight video. We'll have the month end, quarter end, year end video tomorrow. We'll have the podcast. We're doing midday tomorrow. That'll be released over the weekend, and clients can be on the lookout early next week for a year-end client video. So, state of the market, we're in a correction. You can see over here on the trend gauge, leaders still holding up, neutral, red sub arrow, but still holding up, no question. Short term, all five of the major indexes are trending below. They're downtrending 21-day exponential moving average. That's our short-term trend indicator. 50-day moving average still at neutral. We'll take a look at that. Dow reclaimed it today. Long term, 200-day moving average downtrend with the exception of the Dow. The Dow was the laggard today, but what does that tell you that the Dow was the laggard? When the leading index lags, that tells you there's some junk rallying going on. And what just happened today, that's what I see, a bear rally, typical bear rally led by junk. S&P 500 and NASDAQ 100 recovered yesterday's lows that were breaking down. So that's significant from the standpoint that yesterday's lows are now a reference point, and we reclaimed what was a support area. Only acted as resistance for one day before getting back up above it. S&P then rallied into the next logical, well, not logical, it's physical too. You can see it on the chart, but it's around number 3850. And we for over 4.5 hours, we just based around that today in a tight 10-point range. So here are the numbers on the day. G6 up 1.9%, S&P 500 up 1.75%, basically reclaiming the losses of the last 2 days. NASDAQ 100 up 2.4%, not quite reclaiming all of the losses for the last 2 days. Dow up 1%. Mid caps up 1.9%, Russell 2000 up 2.6%, Global Diversified 60/40 up 1.15%, GROTECTION, the big laggard in this list, up 0.04%. Big outperformance the prior 2 days, big underperformance today. In fact, the net is a slight loss versus the gains the prior 2 days. I can't get upset about this because we've got a process. Just like I don't chase a junk rally in the bear market, I don't do a victory dance after reporting Tuesdays and Wednesdays results where we outperform the indexes because, well, I know how bear markets work. And there's always regression to the mean. There's brutal rallies that scare out bears, and there's brutal breakdowns that scare out bulls. That's why the saying is a bear market will have both bears and bulls carried out on a stretcher if you're not careful with your risk control. And that's also why we try to stick to the mantra of selling strength and buying weakness in a bear market. So we'll get to the tail of the tape and then some charts. I'll explain to you why I think today was a junk rally. And of course, I've got the numbers to back me up. So let's go to the S&P 500. Explain briefly what we do at Revere. We are active trend following managers. When the indexes are trending above our short-term, medium-term, and long-term indicators, that's the 21-day short-term, 50-day medium-term, 200-day long-term. We're as involved in the market as we can reasonably be with client money. They start rolling over and selling off, break below the moving averages and the slopes of the lines, roll over, the market will take us out. Not our opinion, it's price action telling us that we're getting weaker or we're getting stronger. We're always paying attention to which way the wind is blowing. If you break below this black line, though, that's the 200-day moving average. And by now, if you follow our videos, you should be familiar with the spreadsheet table of death, which is what you can take a look at if you don't downside protect your downside, all these shaded bear markets going back to 1970 were dream crushers if people didn't protect their nest egg as they were approaching retirement or in retirement. On average, they're all down 44.5%. You need an 80% return to get back to even on that. So far this year, the worst loss was in October. Year to date, down 27.5%. With today's gains, we're down 19 and change percent on the year. Uh, and we've shielded our clients from most of that. And will be just take a decent 12% rally for us to get back to about 13%, 14% for us to get back to even from where we started the year. And if you're interested in an approach like this that protects the downside, participates in the upside, give me an email, don@revereasset.com, or my partner, Dan Stewart, dan@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. So I saw a great article on Market Watch today, something we talk about all the time. We discuss how disingenuous it is for the buy and hold crowd to say, well, if you miss the X number of best days in the market when you're out, then your returns are only barely any returns at all. Well, this article was about the 5 worst days in the market and how they're responsible for basically the entire loss of what the S&P 500 has done this year. So two can play that game. Obviously, it's not a fair game to say, well, we avoided all these losses because we're aware that there are brutal rallies going on during this time. But I've marked these 7 periods with um, these little arrows here pointing out different inflection points. I've talked about this, and really these 7, if you total them all up, they're more than 20% in losses. It doesn't ignore the bear market rallies, which, as I said, will carry out the bulls. There were 2 extreme bear market rallies. Well, really only one extreme one. This one not quite as bad. It was still in the teens, but both of them failed when they ran into the declining 200-day moving average, and that's why we are at a maximum defensive posture under the 200-day moving average. So this first one here, this was a 2-day 4.3% sell-off when Jerome Powell gave a hawkish speech. That was April 21 and 22. Next one, April 29, was down 3.6%. This is when Amazon reported a terrible earnings report, and it hit all the FANG stocks. And this was really the beginning of all the FANG names coming apart. A couple days later, we rallied off of that, though. So everybody's, no big deal. Ran into the declining 21-day moving average. We use this, pay a lot of attention to this because this is our short-term indicator for bear or bull. Ran into that. And then on the 29th, 3.6% sell-off I'm sorry, that was Amazon on 429. Next one was 5.5 after this 3-day rally. This was the day after an FOMC meeting where Powell talked kind of hawkish, but kind of dovish. We rallied into the close, but then the next day the markets digested it and realized that they better start getting out of the way because inflation wasn't under control. And Powell said they were going to raise rates as long as they felt like they needed to. Fast forward to the third week in May, down 4% here. This was Walmart and Target, 2 back-to-back days. Walmart gap down the day before, Target the gap down on the 18th, reporting a complete excess inventory not selling. They're going to have markdowns. They're going to cut staff, and the markets reacted accordingly. Now we rallied off of that as people were waiting for a CPI report, but this next 3-day down period was capped on June 13th with a 3.9% loss on the CPI. This was waiting for CPI, a tight move, everybody hoping inflation was going to improve. We broke down the day before it, and then a brutal rally on 3 days in a row. First down 2.4%, then down 2.9%, and capping it off with 3.9% loss. Total of 5.8% for that week of 617 on CPI. Next one wasn't until, so we went into the rally, uh, hoping this was the first one, hoping the Fed was going to pivot, ran into the declining 21 day, and then on 8/26 we were down 3.4%. This was Powell's Jackson Hole speech where he's saying, we're not kidding, we're going to stick with rates because we've got to tame inflation. The market reacted accordingly. And then following up that on 9/13, down 4.3%. That was CPI. No good information coming from the 9/13 CPI report. We went down further. This was when we put in the low was another negative CPI report on 10/13. Attempted a rally off of that until we ran into the declining 200-day moving average. We had another upbeat CPI report. So this is how you can't trust data. This was a bad CPI report. We rallied off of it. This was a good CPI report. We gapped up, had a negative reversal. The next day was the FOMC. Hawkish Powell saying we're going lower for longer. We broke below the 21. We broke below the 50. The slope of the lines rolled over. That was the failure of the most recent rally, getting back above the 200-day moving average. And now basically we've been going sideways between 3,800 and 3,900 for the last 2 weeks. You can see it pretty clearly here on a 60-minute chart. Well, let me go to a slightly shorter time frame here. So here is 3,900. You can see it capped there on an attempted rally after we broke below that level. And then here's 3,800, which acted as a good support area, but we broke down here. Then we broke down, tested it, broke down again yesterday. This is what really made me feel that the market was giving off more bearish signals. Was this attempt midday to reclaim 3820, and then we just sold off hard into the close. But bear markets, they'll scare out the bears, scare out the bulls. We had a gap up today. The gap up didn't fail. We opened right at 3810, right in the middle of that 3800 to 3820 area, and we just rallied off of it back up to 3850. You can see 3850 acting as resistance all along this area here. Over the going back into last week, any attempt to get above 3850. So we're pounded on 3850 here, closed at 3849. So we need to see it overnight and tomorrow if this 3850 area is support or resistance. This roughly equates to 3875 to 3880 on the futures. There's a 25-point difference in the next futures contract versus what the S&P 500 is trading at right now. So there's your S&P 500 breakdown. Not what I expected today, very clearly, but understand that it's part of the bull-bear cycle, alternating bull and bear action in a bear market. And those 7 points that I pointed to were negative reflection points all throughout the year. Here's the NASDAQ 100. Let's again bring up the 15-minute chart. You can see the breakdown yesterday. Reclaimed it, making this 263-ish area a false breakdown. Let's zoom out a little bit. This 260, 259-ish area played with support here on 1222. One close below, reclaimed it, and then we battled today around 267-ish, 267.30, 267.50. You can see that over here on December 19th. This was support before we finally broke it. So this whole area here will be a support resistance area that we're trying to get back above. How about the Dow Jones Industrial Average? You can see on this 30-minute chart here how it didn't come anywhere near breaking down to recent lows because it's been the strongest. But again, the strongest means on a strong up day where it doesn't participate, it means that the leaders aren't acting well. It means it's junk off the bottom that's acting well. You can see the relative weakness very clearly displayed today. However, it did get back above the 50-day moving average and back into this tight triangle between the declining 21-day and the rising 50-day. Let's go to mid caps. Also had a decent day today, but still trapped below this this axis of evil. The 21, the 50, and the 200 all coming to a point here right around 447, 448. for mid cap. So quite a confluence of resistance there for the mid cap index. We talk more about mid caps than probably anybody else does because we recognize that's the incubator for the next leaders as they grow up and get into the S&P 500. Here's the small caps. Broke lower lows yesterday, reclaimed it today back near the top of the range, this 176 area. Really, 176 to 178 is kind of a dead zone between support and resistance here, so we could bounce back and forth between that over the next couple of days and not really make any decisive move. How did the VIX do today? Market up, VIX down, right? Yes, that's correct. This dynamic still taking place. The VIX down, market up, market down. Broke back below the 21-day moving average, but again, big area of support here around this 20 level that has resulted in bottoms on the VIX and tops in the market going back really all year. How the dollar do today? The dollar was very weak, gap down in the morning, still holding the recent lows, but this has been in an extremely tight range for the last 2+ weeks. How did that impact bonds, or how were bonds impacted? Move up today in bonds, so they held the 50-day moving average. Price up means yields down. Let's take a look at junk, which broke down yesterday. We talked a lot about this, reclaimed quite a bit of yesterday's losses and closed at the top of its range, but it's now below the 8, the 21, and the 50-day moving average in this big 90 area, which has been a support slash resistance area going all the way back to June on the junk bond index. How'd the 10-year yield do? Here's TNX. Well, if bond prices are up, yields are down. 10-year down 1.34%, sitting on the 50-day moving average here. TYX taking a break after 2 up days, an inside day, also sitting on its 50-day moving average. The dollar was weak. How did gold do? Not as good as expected, only up 0.56%. It was up, but faded a bit throughout the day. Here's silver, up 1.71%, and gold stocks were up a lot better earlier than where they finished. This GDX sitting right on the 21, thwarted again at the declining 200-day moving average. So those are all the key high-level indexes that we want to review. Let's look now at the tail of the tape. As we said, in a correction. Sentiment, the VIX, here, this has changed. Stochastics on the indexes flipped to positive. They're oversold and they turned up. So that is certainly something to be aware of. Tells us we certainly can continue rallying because we are oversold. NASI and RSI still pointing down. Dollars under the 21. Rates are above the 21 with the stochastic rising. There's the VIX at 21. Fear and greed up 5 to a 36. We're operating under the bear case as we're below the 21 and the rally failed. IBD yesterday finally went to market in correction, and they were rewarded with their long delay and waiting with a false breakdown that rallied today, making them look not the best look, but could just be a temporary reprieve as we do have quite a bit of headwinds blowing. So some news before the open: jobless claims the worst since January. This gave the futures a little bit of a spike. Our day count went from down 1 to up 1. Here's why, and here's more reasons why I think today was a junk growth rally. IWO, this is the growth ETF. We track this as part of the G6. IWO was up 2.8%. That's the growth part. IWN, the value part, up 2.3%. Remember, though, the Russell 2000 contains a bunch of junk, frankly speaking. Compare that to the S&P 600 small cap. A lot better quality companies in here because they've got to meet certain criteria in order to be included in the S&P 600. The growth portion of the 600 was up 2.1%, while the value was up 2.5%. So here we've got junk growth leading, quality growth underperforming. Let's go to mid caps. MDYG up 1.8%, MDYV up 2.51%. So again, we've got quality mid caps underperforming quality value, FFTY, another component of the G6. Investors Business Daily demands that you've got quality fundamentals in your IBD 50. FFTY only up 1.1% today, while ARK-K, which is the king or the queen in honor of Kathy Woods, the queen of junk stocks, up 5.2% on the day. So under the hood, a lot of junk growth was responsible for the rally today. Expectations neutral coming into today, neutral actually leaning uh, bearish with us being under the moving averages and the breakdown yesterday. But I am still aware of that Santa rally and the pivot 38.22. We got back above it, so we're back into green now on following 4 days of the Santa rally, 3 days left, Friday and then Tuesday and Wednesday of next week. So as far as the levels go, we reclaimed 3,800 on S&P, bounced off support at 259, 260 in the NASDAQ 100. The gap up and trend up, and then a 4+ hour base around 38.50. We have to see how that resolves. 11 out of 11 sectors up today, led by CKY. These are the tech areas, XLC, XLK, and XLY. Biotech, very strong. XBI up 4.3%, IBB up 2.3%, semiconductor strong up 3.2%, cloud stocks strong also up almost 4%. Let me put that in here. Cloud stocks, SKYY. Uh, Gold and silver, as I said, were up, but lagging on a relative basis. Only things that I could find significant that were down were the dollar. Oil was down, nat gas was down, but the stocks were up. They really haven't been staying in tandem quite a bit lately. And bond yields obviously down if bond prices were up today, which they were. So here's our focus list. We'll go through this. I got some interesting stuff in here. No trades in-house today. We're at 0.15, 0.15 on our exposure to the market. So basically 15% of the risk relative to the S&P 500. Bottom line, typical bear rally, S&P reclaims 3,800, stalls at 38.50. We'll see what happens tomorrow as the year closes, and then the final 2 days of the quote unquote Santa Claus rally next week. So let's take a look at what we own in-house. Some of it underperformed today. Uh, BA, certainly a leader, only up 0.28%, more ammunition saying that, yeah, this was a junk rally. Mobileye sold off early, first break below the 21, but it was bought up, closed back above the 21 and the 8, so a nice positive reversal for Mobileye, up 2.8% on the day. TMDX, we still own that, hanging out above the 21. And Nugget, I talked about how this lagged throughout the day, a little disappointing considering that the dollar was so weak. A couple more finishing out the focus list. Tractor Supply acting pretty well. Relative strength at a new high, forming out this nice cup and handle. TTC, let's take a look at this again. This is Toro. Building hand tools, nice tight action here. There can be such a thing as too tight for too long, and we're flattening out on the 21. So we have shown relative strength, however, over the last 4 weeks, but typical of leaders really going nowhere. They're holding up, but they're really going nowhere. That's why you want to buy at the bottom of the range, sell at the top of the range. Here's Agco putting in a little bit of a higher high, trying to break out today, just barely above average volume. ELF, ELF, stands for eyes, lips, and face, hanging around, again, going sideways, flat 21, relative strength, but not price strength, just hanging tight. RXDX attempted to break out today, reverse to close about mid-range, up 0.75%. Geo This is a REIT that's one of the best looking REITs that you'll find. Pulled back, reclaim the 21-day moving average. Connor's going to talk about this. Our newest intern, who's engaging with us, is going to be on our podcast tomorrow, and he's going to talk about this. ORLY, Auto Parts, continues to show relative strength, reclaiming some ground after this harsh sell-off over the past couple of weeks. Schwab, SCHW, going to complete their acquisition of TD Ameritrade and convert the clients later this year. Great relative strength recently, but certainly not a higher high in price relative to a couple of weeks ago. This got an upgrade today. This one again, most of these are on the 21 over 21 list. Great relative strength, moved out today. Let's see if this can make any progress. Average volume today, it's a slow week, but that is a little bit of a breakout above this 54, 55-ish area, closing at 56.46. Crocs, CROX. So many new styles Crocs have. I know people are still stuck in those ugly sandal type look with the holes in them, but they've got hundreds of new styles now. Double inside day Crocs here, near highs, but not making a whole lot of progress. MDGL, that monster gap move up. 2 days follow through, really 3 days, then a reversal up toward the 300 area again. Great action on MDGL. ENVX, bringing this up because they love their product. They've got no sales. Michael's going to talk about this tomorrow on the podcast. They've got what they claim is a breakthrough in battery technology. A lot of info on their website, and they're having 3 presentations next week, and people seem to be front running this, up 15% today, 40% above average volume. We had this in our 21 over 21 list. I don't think we owned it back here when they got everybody all frothed up over 2 earnings reports ago. And then their last earnings report was a huge disappointment. It dropped 41.5%. You're always taking that risk when you've got a company with no sales and that loses money. Of course, they lose money if they have no sales, but they do have cash on hand, and they supposedly can get started. They're looking for partners to accelerate their production process, and the world will find out a lot more about it next week in these 3 presentations. But for right now, gap down, ran into the 200-day moving average. Profits were taken, long, slow decline along the 21-day, but now reclaiming the 21 today with some volume. When we do our volume scans, it shows up. When it shows up, you got to find out why. We kind of knew this was coming. And my biggest reminder on this was their terrible reaction on their last earnings report, but we'll see what happens next week. Could be a sell the pop moment, or it could really be something. The price and volume action will tell us which. GE is spinning off their healthcare unit, which really is their crown jewel now. This is why GE has been rallying over the last couple of weeks. Effective the middle of next week, GEHC, General Electric Healthcare, will start trading. You'll get, if you own GE, you'll get GEHC shares. And it's showing relative strength from some things I've read, a lot of it based on people wanting to get into this GEHC as cheaply as possible. Would not be surprised if that's a big leader. Note the nice numbers on GE here. PE of 36. 2022 estimates up 44%. Next year accelerating up 72%. I don't know what these are going to look like when they spin off healthcare. I don't know how much of this is related to the healthcare, but we'll find out next week when we split them and they split the numbers up. And then finally, a possible short on the downside, brought up by the staff this morning, shorting high yield. Very similar to going short against the market, but high yield inverse broke out yesterday when junk bonds broke down, pulled back toward this confluence yesterday. So basically, this chart is going to be the opposite of JNK. You can see the breakdown yesterday, the rally today, yesterday the breakout, and the pullback today. So that's going to wrap it. As always, love to hear from you. I am Don at RevereAsset.com. Remember, it's not how much you make in the market, it's how much of that you can keep. We're in a bear, we're under the 200-day. In fact, we're under all the moving averages on the S&P 500. We've done tons of studies. We know just from the numbers, not our opinion, that this is the most risky time to be in the market. A lot of people calling for a recession. Is it priced in? Do we know how severe the recession is going to be? Do we know what kind of a PE ratio the market wants to put on the earnings for next year? Do we know what the earnings are going to be? We'll start to find out as we progress through the Q1 earnings reports after the new year starts, and then we'll take our clues from the market. Very possible that we roll over, very possible that we reclaim. But right now, under all three moving averages, and just one day, one close at least above the ultra short term, that's the 80 MA, the purple line on here. But we've been 10 days below the 21, failed again at the 200. Last time we failed at the 200, you see what happened here. Will a similar leg down happen? It happened on the NASDAQ already. We undercut, but reclaimed it today. So, as always, we don't guess. We take our clues from the market. When the market's healthy, we are as invested as we possibly can be, and we're compounding from a much higher level because we didn't lose 20, 25, 30, 35% of our clients' money. Give us a shout or tell your friends and family. And that's going to wrap it. Ending up Thursday, 12/29. This is Don Vandenbord telling it like it is. Thanks for listening and have a great day.